Hello investors. Per dollar invested in a stock, how much business does this company generate? Price to sales ratio is an easy way to answer this question. Here's a formula. Price to sales ratio equals stock price divided by sales per share. When calculating price to sales ratios, it can be easier to look at the total sales rather than per share amount. Sales are reported as a total figure, so you can look at total sales or revenues instead of the per share price and the market capitalization, or market cap for short. Market cap is simply the number of shares times the stock price. Divide total market cap by total sales, and you have the price to sales ratio. Of course, you want to pay as little as possible for the sales the company generates. The lower the better. Somewhere around 1 is usually considered good. It can be a way to filter out undeserving candidates. Taking that a step further, consider Apple's AAPL revenues of $394 billion in 2022. If you divide this number with 15.9 billion in outstanding shares, Apple sales per share are $24.80. With a stock price of $151, it would give the company a P/E ratio of 6.1. Apple sales per share $24.80. In comparison, Google trades with a P/E ratio of 4.5 and Microsoft at 8.9, suggesting that Apple and Google may potentially be undervalued or Microsoft might be overvalued. Most investors would jump on the stock with the lowest price to sales ratio. But one problem with the price to sales ratio is that it doesn't take into account whether the company makes any earnings. So what kind of price to sales numbers make sense? Investors shouldn't look at price to sales ratio in a vacuum. Some companies in basic industries or thin margin retail are often below 1. Low price to sales ratios can be attractive, but it depends on the profit margin. If profit margins are chronically thin or you think they may deteriorate, the resulting earnings will suffer. We can look at price, sales, and profits this way. Earnings yield equals earnings to sales times sales to price. In this equation, earnings to sales equals to net profit margin. Net profit margins are a key element of a successful business. Sales to price is the inverse of the price to sales ratio. So the equation could be restated as price to earnings equals 1 divided by profit margin times price to sales. For Apple, this is 24.1 equals 1 divided by 25.3% times 6.1. For Alphabet is 19.3 equals 1 divided by percent times 4.5. For Microsoft is 25.8 equals 1 divided by 34.4% times 8.9. Now you can see that price to earnings ratio is driven by profit margins and the ratio of price to sales. A high price to sales ratio may be justified for Microsoft by a high profit margin, because the resulting price to earnings will be better. But if a company has a high price to sales but a lower profit margin, in this case Apple versus Alphabet, the resulting earnings yield would be lower and P higher. In this example, as you can see that price to sales ratio is a good way to check if price is in balance with sales, earnings and profit margins. In the 1992 letter to shareholders, Warren Buffett pointed out how value investing and intrinsic value is not determined by single or a combination of ratios. Whether appropriate or not, the term value investing is widely used. Typically, it connotes the purchase of stocks having attributes such as a low ratio of price to book value, a low price to earnings ratio, or a high dividend yield. Unfortunately, such characteristics, even if they appear in combination, are far from determinative as to whether an investor is indeed buying something for what it is worth and is therefore truly operating on the principle of obtaining value in his investments. Correspondingly, opposite characteristics, a high ratio of price to book value, a high price to earnings ratio, and a low dividend yield are in no way inconsistent with a value purchase. Thanks for watching. Let me know your process in the comments. If you enjoyed the video, give it a thumbs up, subscribe for more, and I'll see you in the next video.